Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
Well, thank everybody today. This is, I finally got a little relief from the heat. This is one of the hottest summers we had in a long time.
Hopefully everyone made it through the 4th. I don't know if we call it a weekend or not. That's the first time in a long time it fell right in the middle of the week, right? Some people took it before the holidays. Some people took it after. And, well, some of us took the whole week.
I would just rather have it, like I said, a Thursday, Friday, Saturday, where you can just take an extra day off of the weekend.
Yeah.
This is a weird deal. So the office was empty and filled all the time. So it's really
I'll tell you what, the fireworks were spectacular. As you know, Chris and my wife and I live on Lake Louisville, and if you anchor your boat, if you park by the dam, you can literally see at least 15 different cities on the horizon, from as far west as you can see north to the east. Everything from Flower Mound, Lake Dallas, Hickory Creek, Little Elm, Frisco, the Colony. It was awesome.
We sat out there for hours and they didn't show up. It said there's too much wind, and so it was like 100 degrees that day. Remember?
Yeah, and it was very windy.
And we got no fireworks.
Nothing at all. Did you see any surrounding areas?
Yeah, some, but not much.
It makes you wonder why your city won't do it and everyone else is, right?
Like, I was on Cedar Creek Lake before, and somebody just sent me a picture this year. There are thousands of boats in the middle of that thing watching it. You got to be careful getting in and out of there.
You used to load up on fireworks. I remember off the top of your dock out there.
Oh, yeah.
Of course, you're safe, right? If it doesn't, you're not going to start a field on fire. It's going over the water.
No, I was afraid it would start. They used to go into my house, though.
Start the dock on fire and the boat.
I've had a whole bunch of that stuff. People sitting in the pool watching it, all this stuff's falling on them. So, yeah.
It was a good time.
Oh, yeah, absolutely.
Happy 4th, everyone. Belated.
All right. The stock market's been weird. The stock market's kind of ignoring some of the financial numbers, economic numbers look pretty good right now. We're almost at what they call full unemployment, because like 4% of the people aren't going to work no matter what.
No matter what you do, that's right.
So they pretty much.
And then you got that.
We got trade war talks, tariffs, all that kind of stuff, and it's kind of ignored it. And so I was looking at an article by Scott Minerd. Scott Minerd is the chief investment officer for Guggenheim. He's one of the smartest people I've ever heard. I've probably heard him speak about 4 or 5 times. He can tell you so many details I've never heard before. He'll tell you the gross domestic product of Chile or Guatemala.
In 1948. And break it down by percentage.
Yeah.
It's crazy, yeah.
How that reacts, how much trade they have with Norway. I'm like, what?
I know, right? The memories are just fantastic, aren't they?
So I'm like, whoa. So he's saying the rally in stocks is a last hurrah. He's saying people are underestimating the trade war, even if it's short, what the effects of that would be on a stock market. And he's saying that it's going to happen, but you got to be really, really, careful. He said it may go into August, and he goes, maybe in August it might be a thing. So he's saying probably short term,
August 18th,
there could be a turnaround with the market. So he goes, be careful, because people, what he says, markets are crazy to ignore the risk and consequences of a trade war. Said the rally in stocks is the last hurrah. Investors should sell now. Speculators may do better in August. What he says was, in recent days, he's also pointed the flattening of the yield curve. Flattening of the yield curve means this. Normally, you buy a 1-year bond and you're going to get, say, 1%. 5-year bond, 2%. 10-year bond, 3%. When it's flattening, I mean, you're getting the same long and short.
On the front
An inverse curve would be you're getting less interest for long term and more interest for short term. But all of those things, if you get an inverted yield curve, it creates a recession. It says it's a great indicator of a recession.
Keep in mind, though, too, the smartest guys in the world have different opinions. My initial knee-jerk reaction, and we'll go through it, and there's a lot of good stuff and pertinent stuff, but this assumption I'm hearing from the very beginning of this is that we go into a long-term trade war. Because if it's a 30, 60, 90, 120-day deal, And if you look at the China Stock Exchange, I think it's the Hang Seng, that's their actual version of their NASDAQ, is really down since the beginning of the year. I don't think they can tough it out. And again, this is just another opinion, right? I don't think they can stick it out much longer because they're really getting hurt. So these are assumptions. I've heard this for the last several months now on these tariffs and things. Assuming that we go into a full-blown war where everyone gets hurt, they're all right. They're correct. But it's assuming that that's what happens.
He's saying that the combination of the market being overvalued,
right,
and at the same time getting full unemployment, all these different things, all of those factors combined, doesn't matter if it's short or long, it's going to have an effect on the stock market. Now, the effect might be short, or it might be long.
We've talked about many times about being almost the longest bull run in history. So one statement we can make with certainty is it will correct. What we can't make with certainty is when it's going to happen. Now, I heard on the Bartiromo show, you hear me quote that a lot. It's just an easy deal for me in the morning as I get ready. I forget the economist they had on there, but they said if this expansion, they called it, or growth period in the market lasts to August of 2019, so a year from next month, if we make it to that point, it will pass the longest bull market, expansion market, to use their terms, in the history, period. So, and that came from the 90s. So we're there. And they're all saying right now, our growth this quarter is substantial, right? I've heard 4.5. They're all saying that's going to be the biggest quarter for the year, and then it's going to start winding down some.
You got the yield curve is the one that startles him the most. The yield curve goes inverted. That is predicted 7 recessions in a row. And I'm never a gloom and doom kind of guy. I just know with a Shiller PE ratio of 32, something's got to give. You're going to have some kind of either no growth in the market for the earnings to catch up, price to come down. Something has got to give. It always has. It always will. How much, the breadth of it, who knows? You just got to be ready. But there's other ones. Morgan Stanley's also saying risk associated with America's increasingly aggressive position on trade, that people aren't fully accounting for the risk that's involved. Ray Dalio, he's the founder of the largest hedge fund in the world. What did he say here? I just lost it. Oh, he said something pernicious for market participants has begun. There's a lot of different things like that, because what happens is when interest rates get going up, it starts really hurting small firms and firms that are leveraged and all that kind of stuff. It starts getting them. So either way, there's always going to be a trigger. But remember, everything always turns. It always has, always will. It's what happens is we have this short-term kind of thinking as people. We're going to talk a little bit about that behavioral bias again today. But sometimes they become overconfident because they only let in information that they want to let in.
Oh, they synthesize it to what they want to hear.
That confirms exactly. Now I know for sure. Yeah. Another smart Yale guy said the same thing that I was thinking, therefore it must be fact.
That's right. That's right.
And I can put all my money in AT&T.
That's right.
People do it all the time. It's just the way it is. You want to be confirmed. If you can be confirmed by somebody from like Harvard or Yale, that even makes it more. It's absolutely fact at this point.
And with the internet, it's pretty easy to find somebody that's gone there that will confirm your opinion.
Look at they had that one deal with all the Harvard and Yale economists, that came through, and they said they give this advice. None of them take it themselves.
Really?
They know they should.
They do something completely different.
They said because we're human beings like everybody else. We know exactly what you should do, but as human beings, it's difficult to do it.
Psychology of investing. Right. Thank you.
And that's why a lot of them say that having an advisor, they've commoditized, buying a mutual fund or a stock. You could have a $30,000 account and they'll charge you $5 for a trade. You can have a $100,000 account, they're going to charge you anything. So they've commoditized the actual purchasing of investment products. It's the behavioral biases that advisors help you with. I'll talk about that article in a minute, but that's the one that says is the most important reason to have a financial advisor, just as a second bounce the ideas off of, because we're rational people. We make irrational decisions.
And that's what Shiller said when we were in New York, when he got up. Remember that morning and he was talking. He said, without exception, it helps having a financial advisor walk you through the stuff. And if for no other reason, it takes the psychology part out of it for you.
He's is he either Yale or Harvard?
He's got his own index that he came up with.
No, and the Schiller PE.
Yale, yeah.
Yeah, he's the Nobel Prize winner we were watching in New York.
That's right.
All right, here, our next topic. 5 common retirement budgeting mistakes. We do retirement plans for a living, right? We do financial plans, stuff like that. And we show you, okay, here's the potential outcomes you have. Here's how we can make it better, more efficient.
And sometimes we have to tell you that, the plane that you want may not be a good idea.
Right. So we're going to give you all that kind of stuff. But what happens is when people come up with these figures, they almost always underestimate. Almost always. What they'll do is I want to give you discretionary stuff, and they'll come up, well, I spend, this, and they're not giving you electric bill, water bill, phone bill, all that kind of stuff. All right, my bills are about $3,000. I'm like, well, how much you guys making? Okay, we make $15,000 a month. All right, after taxes, that might be, what, 12, 13? Are you saving 10 grand a month? He goes, no. And I go, so how much you spend outside that? He goes, I guess the rest. People don't realize.
Yeah.
I realize because I put a lot of it on those mileage cards, so I get miles for paying my bills.
And it's an itemized report every month.
I'm like, holy moly. We spent a lot more on our hard expenses than we thought.
And it gives you a pie chart. Shows you how much went for entertainment, how much went for, supplies, groceries.
So the first thing they say is entertainment. People underestimate what they have. Because remember, before you had a couple weekend days open for entertainment. Now you got the whole 7 days.
It's a Saturday every day, baby.
Right.
Ooh.
And so people forget how much they actually spend. What they'll even making spontaneous day trips. They just spend $100 in gas just driving down to Austin or whatever, normally during the week. And they'll do that stuff. They'll eat out the whole time, obviously, because they're not at home. But all of those kind of things, people don't take it into account. So whatever you're spending now in leisure time, you'll probably be spending at least that much, more than likely more, during retirement. And also, when you're giving bills to a financial planner, retirement planner like us, think about what you're actually spending, not your bills, if you want to maintain the same lifestyle.
And a good point to interject here. You may have grown up with the philosophy, Victor and I have, that, when you ask yourself, how much of my income, if I make $100,000 a year, how much will I need when I retire? It used to be, 85%?
Yep.
I would have to say it's probably 100%, and that's really not taking in inflation.
Half the people, it's over 100.
So don't use 85% of your income, your current income, for retirement, because it's probably not enough.
I was talking to
Think about that for a second.
Talking to a client, we set up his stuff years ago, but he's been now going to start the income because his wife's going to retire. And he goes, okay, from the Social Security and this stuff you got me here, my income for life should be around $120,000 a year. I said, is that enough? He goes, I don't know. I was like, now think about, because he's similar to our age, maybe a little bit older.
This is a doctor?
No, it's another client.
Right.
I go, think about remember when you were a kid, you said, man, if I can make $100,000 a year, I'll be rich, right?
Yeah.
If I can save $1 million, I'll be rich.
Right.
Well, not anymore, right? But to think about it now, remember, there's no debts, there's no mortgage, there's no credit card debt, no nothing, no car payments. And to think, I don't know if I can live on $10,000 a month in free cash. That's where we've come, right? That's the way we are now. If you live in Frisco, Dallas, Plano, it's the way it is. You don't realize what you're actually spending, the lifestyle we have now, what it actually costs. And when you have more time to spend, trust me, I can go on Amazon.com. I'd never go on there a week. I ain't got time. Weekend? Let me look at this thing. Maybe I need to get something.
Take a look at how much your home costs. The seals on the window breaks, the ding hot water heater goes, the air conditioning pops, the yard guy, because you don't want to do the yard work, and it's expensive.
The air conditioner right now costs like $15,000.
And how many?
You got a house? We got two or three of them.
Two or three of them.
Yeah.
Oh.
So that's what I'm saying. People don't account for that stuff. You got to have to account for it. Another thing people make a mistake besides entertainment and budgeting for retirement is health care. We know that one. Remember, the average inflation rate for 100 years has been about 3.5%. But that was some crazy times in there, like the late 70s, early 80s. If you take the last 20 years or so, it's been maybe 2.5%, right? So 2.5%, but medical inflation has gone up 7%.
Yeah, it's expensive.
So think about what that means. That means if you're going to retire at 60, by the time you're 80, let's say you factored in $400 a month for health care, all right? It's 4 times that at 80 if it's raised to 7%. remember, it doubles every 10 years. So 400 goes to 800, then 800 goes to 1,600. So by the time you're 80, now you're paying $1,600 a month. Did you plan it for it?
Are you young enough, or you don't have to necessarily be young enough? Are you healthy enough where you can get some good policies now and get them in place?
Right. So that's what the number one thing is that entertainment is always underreported or under planned for.
And
healthcare is another one.
And it's very hard to come up with that number because you don't know.
And that's why, remember, our retirement software, we can actually tweak each one. In other words, we can give you standard inflation on most things, but things like medical stuff that's had the higher inflation, put that in there and account for it. None of these other programs from Fidelity or anything can do that. Ours can. So we'll show you exactly the possibility of what you got. The next is, Guy was just talking about. Number 3 is home improvements.
Oh, yeah.
People forget an air conditioner. I just replaced one last year, $15,000. Then one of my rent houses just went out. And he goes, okay, it's $2,000 for another core, but it is about 10 years old. It's $8,000 for a new one. It's a smaller rent house. I'm like, what? Do you think I have to replace it after I replace the 2? He goes, I think you'll go another year or 2. I'm like, here we go.
Apparently, I've been informed by my wife that our kitchen needs to be remodeled.
Oh, absolutely.
So what's my standard issue answer?
Yeah.
Well, we'll put it in the queue. It's way down in the queue, but it's in the queue.
That's another thing you talk about home improvements. A lot of people want to downsize.
Yep.
Right?
That's
the problem
smart.
is your older house you sell. For the newer house, you probably don't save any money because you don't want an old smaller one, right? You want a new smaller one.
But
the new smaller one costs as much as the other one.
Yeah.
But also,
and your rates are higher.
Yeah, you can't go with those hardwoods. You need to upgrade the hardwoods. I need to put some more window treatments. So the cost of downsizing, including all the improvements you make to the new house and the moving costs and all that, aren't mostly accounted for when they're doing retirement. And so you have to cost. The last thing they say, well, it's not the last, it's number 4, it's family support. Do you know that one-third of households include adults being taken care of by their parents? And these could be 60-year-old kids.
Even if they don't live with you, I'm just saying.
That's right. Trust me, I know.
That's right.
But they're being financially supported by their parents in some way. I think it was millennials, 75% of them still live at home. And they can be up to, 34 years old. And so, since I left my house about 2 weeks after I turned 18, never looked back, that is so foreign to me. I'm like,
that's right.
Why do I want to be on my parents' roof anymore?
Does it have a column in there for loans from family members that will never get paid back?
Those aren't called loans. Those are called gifts.
Oh, and you have to look at it that way going into it. Okay.
I'll definitely pay back.
Oh, yeah,
sure
30 days.
Oh, yeah.
Sure.
I got a check coming in,
And
they get a payday loan.
Then they feel so bad they never talk to you. They won't answer your calls because they feel bad.
You're the a-hole now, right?
Yeah, that's right.
Trying to call. That's right.
That's right.
Wait, I gave you money and I'm the jerk?
That's right.
That's right. So just give it to them if you want to. If you don't give it, because this loan stuff does not work.
That's right.
The last thing that people underestimate when they're planning for retirement, life expectancy. Oh, this happens more often than I could count. We've been doing this 30 years. No, that they think they're going to live a certain amount.
Okay. Gotcha.
No, Victor, you don't understand. I'm 65. Nobody's ever made it past 70. I need to plan for 10 years. I go, okay, what if that happens and you do 11th year and now you're eating cat food for dinner? Does that? No, it won't happen. I go, they'll keep you alive when you don't want to be alive anymore. I go, my stepmother, they said she's got 18 cancer spots in her lungs. She will not last 6 months. We're saying goodbyes and everything. That's 20-something years ago.
No kidding.
Yeah, and she's still smoking. Take the oxygen mask off.
They have a cigarette?
Smoking, yeah. I'm like, you're going to blow up in here.
She's not a quitter.
No quitter in
She's
her.
not a quitter.
But right now, remember, the life expectancy just keeps going up and up. Remember, a man's going to like 30-something%, a woman's going to like 14%. But the average 65-year-old American is likely to live an additional 20 or 19.4 years. So I don't care who you are. I like planning for in my 90s, at least mid-90s, 100. It's okay if I ended up with some extra cash because I died at 88. My kids will get more, whatever. But the worst thing that I could think possible is being old and feeble and not having a dang penny to pay the bills. And like living on the street or eating, can't eat food, or I got to ask my kids, which my ungrateful kids probably only let me in. So make my kids, suffer through everything else, changing me or whatever.
Oh.
So those are the kind of mistakes you really, really have to think about. So when you're planning for your retirement, whether it's through us or anybody else, don't put some static number of hard expenses on there, because it is not like that. You're going to have to make sure you account for increased entertainment, increased medical costs, increased moving costs and housing costs, replacing an air conditioner every once in a while, roof, whatever. The deductibles on roof a lot of times average 2% now.
And what's the one cardinal rule when doing that not to do? You can't put this plan together based on an 8% return or a 10% a year return. Because if you do, I tell you right now, you're going to have a pretty good retirement.
I'm telling you, we've been doing this a long time.
Yeah.
And you'll have very smart people, could be a surgeon, that will argue with you and told you the last 20 years they've made 14% a year. I said, well, how much do you have now versus 17? He goes, well, I put in, I had like $5 million there, and I've got like 8 or 9 now. I go, you know how much it would be? I go, and you added money to that the whole time, right? Every year you added money. He goes, yeah. Without adding money, it should be like $6 million if you made that much.
Figure the rule of
they don't realize
72, right?
Yeah.
7.2% interest in 10 years. He said over
That's
20
right.
years,
Yeah.
that $5 million would have been 10 in 10 years, and it would have been 20.
That's right.
In
5 turned into
20 years, yeah.
Right. But what they'll do
At
is
7.2, not 10%.
they'll have some equity position that made this.
Right.
They didn't tell you that 80% in a money market making 0.1. So their overall portfolio didn't make 2.
Absolutely.
But think about it. If you made 5.27 on the market the last 18 years, that's exactly what it's made. No fees, no nothing, 100%.
Dividends.
Yeah. And you had half in bonds or CDs or whatever. You might have averaged 2 or 3% on that.
Which you should do.
Absolutely. You only got 4% if you equal the top investors in the world.
Ever. That's right.
And 4% for 20 years would actually be a decent number. It'd be double your money, by the way.
But then you're thinking, well, that's silly. I could have had all of it in there. Well, you could have until 2008 came around, and then if it was $5 million, that you're back down to $2.5 million.
Well, let's go to a topic that makes me cringe every time I think about it. Divorce.
I was trying to think of something clever.
I've got some horror memories, bad memories in there. It's
didn't
not
come
good.
to me.
And giving up half my stuff several times. It just doesn't feel good to me, right? I'm just saying. But they've changed the law. Remember, 20 years ago, there was no alimony in Texas. Now there's alimony in Texas. And it used to be when you're giving alimony, you're the one paying this thing. If it's $4,000 a month or whatever, you get to claim that as a deduction. And the person receiving the income would get to have to claim it as income. And so you're getting a deduction on the amount you're actually having to pay because it reduces your taxes. They're having an increase, so they're not getting as much, right?
Right.
Because if they're getting $4,000 a month, they might have to pay $1,000 in taxes on it. So that law, I don't know how to say this the PC way. If you're going to get divorced, if you're in the middle of it, if you're the high wage earner, you might want to get it done before 2018's over. Because when 2018's over, January 1st, 2019, it's no longer a deductible expense for the payee.
Oh, that's
Or
right.
the payer. And the one receiving it does not have to claim it as income. Yes. So
in other
really
words,
good for the low-earning spouse.
The payer is paying the taxes on it, so the payee doesn't have to.
That's correct.
So I wonder if the judgments or the amounts will be a net amount. Well, I would have given you 4, but since you don't pay taxes,
That's
you only get 3.
exactly what I'm saying. What happened is now all of the lawyers are going to be lowering the amount that people get. The problem with that is the low-earning spouse, right, usually isn't in a high tax bracket. They're not making much money. So they might not be paying hardly any taxes on that for it. They would rather have it where they pay taxes.
Got it.
The other guy gets a deduction, or the gal get a deduction, and they pay the taxes.
At the bigger rate.
Right.
Yep.
Because remember, he's deducting it at a much higher income.
Yep.
She's getting income with no taxes or very low taxes. That works better for people, but the IRS gets less money.
And it's not because of a PC here. It's not because of a man or a female. No. Remember, this thing is predicated on the highest wage earner.
Yeah,
it could be the woman being the highest wage earner, and the guy was kind of a house husband or did something modest, and now he's going to be in the lower bracket and get the the money.
It is gender neutral, but 97% of alimony is paid from dudes. That's in this study too. But it's from a lot of them are older.
A lot of carryover.
Right. But I thought about that, and I'm like, so if you're going to pay the alimony and you can't write it off as a deduction, holy moly, because some of these people, these lawyers get, I don't know, 10, 20 grand a month, I think, if you've got a lot of money. And so I'm like, ooh.
Didn't they have a limit on that at one point?
I have no idea.
Well, I thought
Hopefully
you were the expert.
Hopefully I'll never find out.
Amen.
Used to be you had to be married a certain amount of years and all that kind of stuff. But think about that. That can have a big impact on, because what they're doing is saying maybe you should give property instead of income. Give it a little more property.
Kind of like gifting sort of thing.
If you did that, they're not going to pay the tax, and you're not going to pay the tax.
Do some tax
So
planning.
the lawyers are going to be hard at work trying to figure out a way to get each one of them in the similar net position.
And this is a real good example of what happens every time the tax code changes and the tax law changes. Think about, you've got your plans based on the estate taxes and all of that stuff now, and then they change it. Fortunately now, they're changing for the better. But, at some point, we get the wrong parties, and they're just saying it may swing back the other way.
Remember, like I said, we're just talking about what divorce does. Divorce has actually stopped growing. First time in decades.
That's good news.
But gray divorce, over 60 divorce, or over 50 divorcing, has increased like 7 or 10%. I always talk to people like, I got, customers all the time. They're like 65 years old, been married for 50 years. And he goes, oh, I was just waiting for my grandkids to get out of school, blah, blah, blah. I couldn't wait to get out. I'm like, well, hell, you're 65 now. What are you going to do? Or 75. He goes, I don't care. I got peace.
I just don't want the drama. No, I don't understand. No, I don't get that at all.
Right. So when you're a divorcing couple, not only you got to think about those issues, but you also got to think about when you're a couple, you have shared expenses for electricity and stuff like that and water. Now that's separate. And a lot of people aren't. Also, it used to be where you could write off your children, right? And that was a big negotiation. Who gets to write off the kids? Obviously the spouse that has the kid, but sometimes they'll have a joint custody where it's actually 50-50.
Right.
Who gets them is a big deal. Well, those credits have been eliminated. So you cannot deduct your kids any longer. They have a child tax credit that's actually better because it's $1 for deduction, but most of us can't qualify for a child tax credit. You only have to make a little bit of money.
Yep.
So there's a lot of things. Also, remember, the last thing about getting divorced is this. If you're over, I think it's 62, it's either 60 or 62, and you were married more than 10 years, you still qualify. Let's say you never worked because you were the homemaker and you were taking care of the family.
Going to Social Security.
Right. They can get their Social Security, their spousal benefit, which is half of their full retirement age. But if you're under 60, there's a difference if you're over 62 or under. If you're over 60 or 62, you can actually take the spousal for the years, delay yours until 70 to get it to increase, and then cut that one off and start yours.
And half of the spousal may be significant for you.
That's right.
Depending on where they are.
That's right. So you could do that both. You can't do that if you're under 62. You'll just still get part of their what's good. You can't be married again. There's rules. You got to be a certain age.
And we
at least 62 when you take it.
Really hope that you're not in that situation. But if you are or have any Social Security questions, we've got some great software. You've heard us talk about it probably every show. Happy to do it for you. Truly, there is no obligation. And with your information, we can run it and show you the best way for you to maximize your Social Security.
Yeah, we try to do these. I help people split up assets all the time.
Sure.
But there's all kinds of things you have to think about, like increased expenses per person, differences in tax rates. Remember, you're going from married to individual.
Yep.
Significant increase in taxes. Are you still prepared for retirement? Because somebody might think they are because they've always made $200,000 a year or whatever, but after that divorce, they're going to have to work a lot longer to get to the same position they were now. And the other spouse, the lower earning spouse, may even have an issue where they can't have that lifestyle anymore, which is unfortunate. But
something that is not in that article, I assure you, is when you manage the assets for both of the divorced couple pre and post divorce and they don't get along. That's always interesting.
Yeah, I know. You have to separate and they can't tell them about each other's stuff.
At all. That's right.
They are completely separate at this point. Well, I want to thank everybody for listening to the show today. Remember, if you have any financial questions, if you're about to get a divorce or anything else, don't hesitate to call our hotline. It's 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Also, remember, we offer the no-cost, no-obligation full retirement plan, financial plan, and Social Security optimization. We throw in that. This is the most comprehensive software known. Call us at 972-715-2424. I'm Victor McClure. For Guy Allett, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.